What is going on, guys? Nick here, back with another video. PE ratios are the most common way that people figure out if a stock is expensive or not. Now, I love using PE ratios, but I see way too often people are using PE ratios in the wrong way, and it's holding them back from all the money that they could be making. So in this video, I'm going to cover the 5 most common mistakes that I see using PE ratios, and what you should do instead. Mistake number 5. Now let's say I'm going to sell you one of 2 magic plants that grow money. Right now, these plants are pretty young, so they only grow $1, and it takes a whole year for them to grow it. Well, one of these plants costs $15 and the other one costs $50. In other words, one of them has a price to earnings ratio of 15 and the other has a price to earnings ratio of 50. So which plant should you buy? Well, the one that costs 15 does seem like the better deal, right? I mean, they both only earn $1.
No.
Right now, we're missing some really important information. How quickly do we expect these plants to grow going forward? Now, what if I told you that while both of these plants grow $1 over a year, the $15 plant grows 3% more money each year, and the $50 plant grows 30% more money each year? Which plant do you now think is the better deal? Well, if we look at this chart showing how much money the magic plants will grow over the next 10 years, you can see the $50 plant has already started turning a profit, but the cheap $15 plant only grew $11, which is still a little over $3 short of what you paid for it. Now, PE ratios are really all about how long it's going to take for that business to earn what you paid to own that part of the business. If that business is growing really fast, you should expect to pay a higher PE ratio. But just because a PE ratio is relatively low, it does not mean that the stock is automatically a value pick and worth buying. Mistake number 4. Let's take a look at the PE ratios of the biggest banks in the US. Now, one of these stands out as pretty cheap compared to the others. And look, all these are big banks that are pretty comparable and relatively similar types of companies. We should be able to realize that Citibank is pretty cheap compared to the other 4, right?
No.
Here's the revenue and net income for each of these companies over the past 10 years with the forecasted next 3 years of revenue and net income. Now, the order on the screen is randomized, and if we ignore the PE ratios for a second, which one of these businesses seems like the best one to buy? I'll give you a second to think about it. Well, this one looks the best to me with pretty steady growth in the past and a pretty good forecast going forward. This one's probably number 2 with the second most growth, but the next few years don't look quite as good. And these two have been really consistent but totally flat growth, and this last one has been really inconsistent and doesn't show much growth and is probably the worst buy of the 5. Now, based on the way that I set this up, it's probably not that surprising to find out that Citibank is the one with the worst revenue and net income chart. By the way, if you were curious, number 1 was Bank of America, number 2 was JP Morgan, and number 3 was Wells Fargo and US Bancorp. All the time, I see people take relatively similar companies and compare their PE ratios and decide that one must be better just because it has a lower PE ratio. But we really need more information to figure out why one is so much lower than the others.
Mistake number 3.
Tesla is trading at a PE of 511. There is no way they can sustain this price. It is about to come back down.
Sarah, this is a beat on the top and the bottom line and a beat on the bottom.
Tesla is trading at a PE ratio of 804. It is about to crash. Cash out while you can.
Hey, Wolf, we've got a beat on the top and the bottom line for Tesla. The earnings
For the last time, Tesla's PE ratio is 1,102. There is no way that this stock can stay this high. Now, this guy does have a point. A 1,102 PE ratio is pretty high. But this internet commenter is missing out by only looking at trailing earnings. In Tesla's case, the earnings per share was jumping really fast. But by only looking at the trailing earnings and not the forecasted earnings, it's impossible to understand why the PE ratio would suddenly jump up by so much. Now, it's actually really easy to pull this forecasted earnings up. If we pull up Tesla on the Yahoo Finance app, we can just scroll down here to details and then go to show all analysis data. And then right here we can see under 2022, Tesla's projected to earn $7.22 per share. Now, Tesla's PE ratio today is about 414, which is a very high number. But Tesla's current 2022 analyst estimate is to earn $7.22 per share. This means that the stock is trading at a forward PE ratio of 109. This looks obviously way better than the 414 trailing PE ratio. So unless the forecast for the 2022 earnings come down, the stock should have no problem sustaining its current price.
Mistake number 2.
moving all stocks to cash. The market is overvalued and in a huge bubble. The S&P 500 PE ratio is at an all-time high, 36, almost double its average. Now, this mistake should hopefully ring a few bells from what you've already seen in this video. Number one, we all know that businesses have had it pretty rough over the last year because of the pandemic, so we expect earnings to be a little lower than normal. Most of us, except the perma bears who are always expecting a crash, expect earnings to come back to normal over the next year or two. So we need to look at the forward PE ratio and not the trailing PE ratio. Number two, look at the top 10 companies from the S&P 500 in 1980 versus today. In the 80s, it was IBM, AT&T, 7 different oil and gas companies, and GE. Today, it's Apple, Microsoft, Google, Amazon, Facebook, Tesla, Berkshire Hathaway, Nvidia, JP Morgan, and Visa. Most of these companies are large tech companies that are able to grow their earnings much faster than these companies used to. On top of that, look at the rates of the 10-year Treasury bonds. At one point in 1981, you could buy a bond from the US government that would literally pay you 15% of your money back every year. And now that number has come down to just over 1%. Imagine how much less interested you'd be in buying stocks if you could literally get a 15% bond from the US government today. So it's a perfect storm of all three of these things that are driving the S&P 500 PE ratio to all-time highs. High growth companies that don't take a lot of additional cash to grow, historically low payouts for bonds, and a global pandemic that's temporarily hurt earnings, and we all expect things to get back to normal soon. The market is not overvalued, and anybody who's completely cashed out is making a huge mistake.
Mistake number one.
I've had some lucky days in my life, but one of the luckiest was in 1949 when I was 19 years old in Lincoln, Nebraska, and I picked up a copy of The Intelligent Investor. It not only changed my investment philosophy, it really changed my whole life.
Current price to earnings should not be more than 15 times average earnings of the past 3 years. So should I only buy stocks with a PE ratio under 15? Now, let me be clear. I'm not saying that Warren Buffett and Benjamin Graham are wrong. This book was written in 1949. In the 72 years that passed since this book was written, a lot has changed. I'm saying that Warren Buffett doesn't even follow this rule himself anymore. If we look at the stocks that Warren Buffett's company Berkshire Hathaway owns, where they have a position larger than $1 billion, there's currently only 5 of them that have a PE ratio between 0 and 15. The median PE ratio of all these companies is actually 28. And this again goes back to what I talked about earlier. The market has completely changed. Treasury bonds don't pay out anywhere near as much, and companies don't have to build these massive expensive factories to make money. If you're looking to buy stocks based off an arbitrary PE ratio of 15, you're going to miss out on a lot of great opportunities. Now check out my latest video right over here, and as always, thanks for watching.